Peter, the only thing dominating markets is the question if this relief bill actually brings inflation in a couple of weeks. What does it mean, or months once they're dished out? What does it mean for your equity strategy forecast?
Well, we are overall still positive on equity, so we think the free cash flow yield forward is still around 5.5%, so that's pretty attractive given what you're offered elsewhere. So we are very constructive on equities, and we think the next 18 months will provide solid growth. We now have the new stimulus bill from the US. We'll have China, we think, also doing more fiscal stimulus later into the year when their base effects kick in and their economic growth numbers year on year look a little bit less rosy, and then they will do something. So you think we should still be overweight equities, but within that framework, with the rising inflationary pressures, rising prices, higher interest rates, we think we could go to 2.5% when the output gap is closed in the US by the end of the year. When we get through on that journey to 2.5%, the rich pockets of technology stocks, which are richly valued, will be very sensitive to these rising interest rates because it lifts the discount rate of their future cash flows, which are fine to the future. And that's a result. We think this divergence right now that we're seeing between S&P 500 and Nasdaq 100 will continue.
Peter, where's the biggest bubble and when will it burst?
Well, the biggest bubbles we currently are looking at, I think, is within green technology. It's also within what we define as bubble stocks, so companies with an enterprise value to sales above 10 and negative earnings forecast. You could argue some areas within the US biotechnology sector or industry, if you will, is also look quite bubbly. That's part of the whole ARK Invest and ARK Innovation ETF complex. Those sorts of places are very interest rate sensitive here in the short term, but long term, a lot of these technology stocks will continue to do quite well, we think, because the long-term driver of any company and any stock price is, earnings growth and revenue growth, and that is still in the technology space. But short term here, we have a lot of trouble, I think, with these rising interest rates.
Peter, you just said you think that the divergence between the Nasdaq 100 and the S&P is going to continue. I was showing a chart just a little bit ago with the Nasdaq kind of pulling away from the S&P. Obviously, it's had its issues with rates rising and that scare. But here you see it again, the Nasdaq 100 in blue, the S&P in yellow. You expect the Nasdaq to continue outperforming?
Now, what I mean is that when we crossed the 1.2% in the US 10-year, it was very clear that the interest rate sensitivity was kicking in among bubble stocks and Nasdaq 100, whereas the S&P 500 was holding up pretty well. Now we had an all-time high in the close yesterday in the S&P 500. We're still down on the close around 5.5% of the Nasdaq 100. And today you're seeing the US 10-year yield creeping back to 1.6%, and the interest rate sensitivity is kicking in again. And now you're seeing that divergence. So Nasdaq is underperforming the S&P 500 and Europe and the likes. We think that divergence that will continue as we move towards those 2.5%, because a lot of the internals of equity valuation will have to adjust to these higher discount rates. And when we have closed the output gap and we go to that 2.5%, then we can talk really long term again. And then I think the technology sector is still a place where you want to be overweight. But on this journey to 2.5%, it will be a bumpy ride for some pockets of the technology space.